Welcome everyone. We'll give everyone a second to join here, um, and then we'll get rolling. Awesome. Welcome and thank you for joining us for an MP Wired for HR webinar. Thank you for joining us today on our ACA Compliance Made Easy, an educational event. I'm Katie Kretter, Marketing Manager here at MP. For those of you joining us for a webinar for the first time, MP combines cutting-edge, user-friendly HCM software with proactive white glove customer support, recruitment process outsourcing, and HR services that help business leaders abreast of the latest HR updates and compliance requirements. I'm super thrilled to introduce your expert for today's webinar, Paul Corellis. Paul has over a decade of experience in the HR consulting space, working with businesses of all sizes and industry. Paul leads a team of SHRM certified HR professionals here at MP, and together they assist clients with compliance, training, and HR guidance and support for the full employee lifecycle. And just a few housekeeping issues before we get started here today. If you would like to submit a question during the program, please use the Q&A feature at the bottom of the screen, and we will also be sending out the recording and the presentation slides after the webinar. Thank you everyone for your time, and now over to Paul.
Awesome. Thanks so much, Katie. Good afternoon, everybody. Great to be speaking with you all again. This has become an annual tradition, our Affordable Care Act, or ACA webinar. I'm trying to get out ahead of it this year a little bit, give everyone enough time to plan and strategize to make sure you make this as easy as possible, because like many other things, planning and preparation and good housekeeping and good record keeping can really take a lot of the stress and burden off of your ACA responsibilities as a business. So in terms of what we hope to cover in the next hour or so, we're going to do an overview of the ACA. In this economy and in this day and age, a lot of businesses have been growing, and there have been mergers and acquisitions, and employee counts have been going up, which is great. But what that also means is people start to crush the magic number of full-time equivalent employees that make you subject to things like the Affordable Care Act. So I know, and speaking to some folks ahead of time, we do have some folks who are new to the ACA, so we'll do a little bit of an overview. We'll talk about due dates and penalties. There are some changes there that we'll want to make sure we cover, just so you know when things are due and what you can potentially face if you're out of compliance. We'll talk about some of the changes for this reporting year and next reporting year. One thing that we're seeing a ton of over the last 6 months, and hopefully no one on this call has been subject to this, but we're seeing a lot of IRS activity about the ACA. So especially dating back to the 2020 and 2021 tax years, the IRS is catching up on their record keeping for ACA, and they're starting to send out inquiries, audits, some cases demands and penalties related to previous ACA filing years. So something to take very seriously, but something not to panic over. We do offer support in that area, so we'll talk a little bit about what to do should you receive one of those letters in the mail. We're also seeing a lot more employers adopt independent coverage health reimbursement accounts, or ICHRA plans. So those have a very specific interaction with the Affordable Care Act. We'll talk about that. And then, as always, I'll hopefully allow time for some Q&A. So as Katie mentioned, feel free to throw questions into the Q&A feature within Zoom, and we'll get to as many of those as we can. All right, so in terms of an overview, the ACA is going to be celebrating its 15th anniversary coming up next year. It was signed into law in March of 2010. There were several challenges to the Affordable Care Act, but each of those went on to the Supreme Court, and the ACA survived all three of those challenges, the most recent one being in 2021. For those of you who were in business back in 2010, you may remember this wasn't an all of a sudden compliance thing. There were gradual implementations of it. So, and there are some things not affecting what we'll necessarily be talking about today in terms of the required offers of coverage and all of the tax filings that you have to do. There are other aspects of the Affordable Care Act that dealt with how compliant insurance plans have to be written and what they need to include, and kind of what they can charge as well. So among those were guaranteed coverage for pre-existing conditions. Insurers cannot deny folks due to a pre-existing condition. It also extended coverage for children and dependents of insurance holders through the age of 26. It also, what a lot of people may not realize, it did create the legally required lactation breaks for nursing mothers in the workplace. Also eliminated lifetime coverage limits on insurance plans. Provided free preventative care screening. So if you do have insurance or through a group health plan, and maybe you have a high deductible or something like that, um, you may notice that even if you have a high deductible, your annual physical and things like that are not subject to that. So that is one of the benefits of the ACA. Also created some rules for employers, and this may impact your business. Some companies would have a pretty lengthy waiting period before a new hire was eligible to jump on the group health plan. And under the ACA, those cannot exceed 90 days. You may recall back in 2018, we did have the employer mandate for the ACA that we'll be talking a lot about today, as well as the employee mandate. In 2018, the individual mandate was successfully repealed. So what that meant was that as an individual, at least at the federal level, you cannot be penalized if you do not carry health insurance for yourself. Um, Certain states do have their own individual mandates. I'm currently sitting in Massachusetts, and here in Massachusetts, we are subject to an individual mandate. If you are also in Massachusetts, you probably notice that when you do your annual income tax filing that you have to supply some information about your health insurance coverage. So what's new? There is an increase in penalties for both the non-offer penalty, meaning you didn't offer insurance to all the folks that you should have, as well as the affordability, failing to offer affordable coverage in 2024. So the penalties for this year that we're in right now and that will be filed and reconciled in January and first quarter of next year, those penalties are up from 2023. They have released the penalties and the fee structure for next year for 2025, which will be filed in 2026. And those are actually going to come down slightly. So they'll still be higher than last year's numbers, but they will be lower than 2024. So we'll talk about those in a few slides. There's also going to be some relief in terms of affordability. So we'll get into it a little bit further, but basically the government determines what percentage of an employee's household income can be charged for the lowest cost individual coverage of a plan. So what you kind of have to do is in your plan design or plans design, when you're watching affordability, you're also always looking at your lowest cost option if you have multiple plans. It doesn't have to be the one that the employees necessarily sign up for, but that is available to them. The lowest cost option and the pricing for the employee only coverage, not the family or employee plus spouse or anything like that. And that is how you determine your affordability. So for this year, the affordability number was at an all-time low. Basically, that out-of-pocket employee costs could not exceed 8.39% of their household income. Next year, it is going to go up, and by a fairly healthy amount. It's going to be all the way up to 9.02%. So again, some relief for next year, but we are in some all-time highs in terms of penalties and a all-time low in terms of the affordability percentage. So this may be a tough year for some employers, depending on employee compensation, the cost of your healthcare plan, so on and so forth. They have also eliminated the option for paper filing your 1094 and 1095 forms. So those are the tax forms that you need to file under the Affordable Care Act. So they've essentially eliminated that. Also, we talked about a gradual implementation of some of the ACA functions back in 2010. They also, for a great long time, for the majority of the time that the ACA has been in place, had what they called kind of good faith, where if an employer kind of stumbled with their ACA compliance, but showed that they were trying, that they weren't maliciously ignoring it, or, obviously not offering insurance to anybody, if people were making an honest, good faith effort, they were given a lot of runway to make mistakes and not be heavily penalized for those. But as of last year, the IRS said good faith is no longer here, and they're going to hold everyone to the same strict standards for ACA compliance. There was also this kind of funny thing where under the language within the Affordable Care Act, there were end of January due dates for all of the filings, and every single year Congress would pass a thing that would allow them to extend that due date into March. And so what they did last year was permanently adjust that due date. So we no longer have to wait for intervention from one of the government agencies or from the legislature to extend the due date. Those are permanently extended, which is good news. And then obviously, unless you're living under several rocks, you do know that we do have a new president-elect. Um, he was the one behind the 2021 Supreme Court challenge of the Affordable Care Act, which was unsuccessful. Um, Looking at what was said during the campaign, President-elect Trump did say that he was not looking to eliminate the Affordable Care Act any longer. So in terms of what changes he may look to make, those obviously remain to be seen. So everyone over on the HR services team at MP is keeping a very close eye on that. Should there be any substantial changes to the Affordable Care Act that alter how businesses should act and comply with it, we'll be sure to get that out to everybody. But as of right now, we're just watching it very closely. So during the Biden administration, we really saw an explosion in marketplace participation. So this is when individuals go to healthcare.gov or their relative state exchanges and sign up for insurance individually through the marketplace. The government increased the level of subsidies substantially during the Biden administration, which made coverage much more affordable for many individuals, and we saw a corresponding spike in enrollment. So 2023 was a record-breaking year. 2024 even topped that. So there were 20.5 million folks covered under marketplace health insurance plans. The Congressional Budget Office is estimating that it'll be over 22 million this year. So right now, open enrollment is going on. It's been, I think this is the second week of the open enrollment period under the healthcare.gov marketplace. So we don't have data yet for how that's going, but according to estimates, they're expecting this year to break a new record. So before we dig in too deeply, and I'll try my best not to use jargon and things like that, but I did want to go over a few key terms and abbreviations that you might hear during the presentation today. So first is ALE, which stands for Applicable Large Employer. So if your business is an ALE, that means you are subject to the Affordable Care Act and you need to be in compliance with it. The definition of an ALE is a company that in the previous calendar year had 50 or more full-time equivalent employees. So FTEs is also an important term. So what the definition of a full-time equivalent employee is someone who works 30 or more hours per week. And we say full-time equivalent because under the Affordable Care Act, businesses are required to count the hours of folks who are not full-time themselves. So what you'll see on the screen here is an example of that. So anyone who works 30 or more hours per week is considered an FTE. So you count those people as one. And then for anyone who falls under that 30-hour average per week, you then kind of add up those hours and divide. So if, for instance, easy math, you had two part-time employees who average 15 hours per week, those individuals themselves may not be eligible for your health plan, but you do have to count them in your count towards being an applicable large employer. So those two 15-hour-a-week employees would count as one FTE in your count towards that 50. There is also another important category, especially for those of you who may be in home health. And I can't say it with certainty. The IRS hasn't gone out and said this, but we're seeing the home health and the overall healthcare industry really being hit by some of those inquiries and penalty notices. And those groups, retailers, hospitality, they tend to have a lot of what's known as variable hour employees. So this is a legal term within the Affordable Care Act. And what a variable hour employee is someone who at the time of hire, the employer really can't say whether they're going to fall above or below that 30-hour per week mark. So there is some flexibility with how you handle those people. You're allowed to use a longer measurement period to determine whether or not they're going to average full-time hours. But you need to be very careful. You can't abuse it. If it's suspected that you're taking advantage of the variable hour kind of safe harbor, then you can get yourself in a lot of trouble. But that being said, there are a ton of industries that legitimately do employ variable hour workers. So you want to just handle those carefully, make sure you have good record keeping practices and working in a system that helps you track their hours accurately. All right, and then a few other key terms that you'll hear used: the measurement or look back period, the stability period, and the administrative period. So your measurement or look back period is going to be the time frame in which you look back and see how many hours did your employees average, who was above the 30 hours per week and who was below the 30 hours per week. So that's going to be your look back period. Under the look back model, you can use anywhere from 3 months to 12 months. But generally speaking, most employers will use a 12-month look back just to relieve themselves of the administrative burden of having to recheck it, more than once a year. The stability period is the amount of time that anyone who qualified during the look back as being full-time needs to be guaranteed coverage. So what that means is that, and the stability period always has to be at least as long as the look back period. So let's say you're using a 6-month look back. So you'd be looking back at the previous 6 months, and all those employees who met that 30 per hour per week threshold would then be offered coverage, and they would need to be able to remain eligible for the health insurance for at least the following 6 months, even if their hours dip below. If their hours dip below, then that would obviously affect their eligibility for the following look back period. But for whenever you use to measure, one note, if you're using a 3-month, you do have to use at least 6 months for stability. But other than that, your stability period would match the length of your look back period. And then finally, the administrative period is the amount of time that you kind of give yourself to do your record keeping, do your measurements, make your determinations, and do your open enrollment. So here, if we look back at a example from a few years back, these people follow kind of the calendar year. So they're looking back at from 1/1 to 12/31. They're giving themselves a 1-month admin for the month of January, and then their stability period runs from February through the end of January the following year. So I've already kind of explained exchange and marketplace. Those are kind of interchangeable terms. Some people refer to these things as the healthcare exchange. Some people refer to them as the healthcare marketplace. Both essentially mean the same thing. So what are your requirements if you do your math and determine that you are an applicable large employer? If you are an ALE, you must offer coverage to at least 95% of your eligible employees. So they give you kind of a 5% margin of error. But if less than 95% of your eligible folks are not offered coverage, you can find yourself in some trouble. And then, as I said before, what you're really measuring is the cost for an employee if they were to take your lowest cost option and elect the employee only coverage. So that's kind of where that affordability piece comes in. All right, so let's talk about some due dates. So we'll go over these in more detail. Essentially, 1095 forms are somewhat similar to a W-2. You issue those to each of your benefits eligible employees. So all your full-time employees will receive a 1095 from you. Most likely it's a 1095-C. If your health plan is self-insured, then it would be a 1095-B. But if you have questions on that, feel free to reach out to us over at MP and we can discuss that together. But your 1095 forms, whether they're B forms or C forms, are due to employees next year by March 3rd. If you have employees in California, please note that you have to get 1095 forms to them by January 31st. Rhode Island also was previously a January 31st date, but last year they decided to get in line with the federal due date. So if those of you have employees in Rhode Island are used to the 1/31 deadline, you are now extended until March 3rd as your due date. Again, paper filing with the IRS for your 1094 and 1095s is no longer accepted. The electronic filing of your 1094 and 1095 forms is March 31st of next year. Should you need an extension, employers are eligible for an automatic 30-day extension by completing and filing what's known as Form 8809. So that would give you an automatic 30-day extension, which would give you until the end of April to take care of your filing with the IRS. That does not absolve you of your deadline for the 1095s to the employees themselves, though. All right, so let's talk about the scary part. We'll try to make this as unscary as possible, but it is important to know what you're potentially facing for non-compliance with the ACA. So there are two buckets of penalties, the non-offer and the affordability. So the non-offer is the most expensive penalty you can face under ACA non-compliance. If you're found to have not met that threshold of offering eligible coverage to 95% of your eligible employees, you would be subject to the non-offer penalty. And what makes the non-offer penalty so hairy is that they don't only base it on the employees who are not offered coverage, they base it on your entire workforce. So they look at your FTE count. So in our example here, we're looking at a company with 100 FTEs. So the penalty is for 2024 is $2,970 per FTE minus the first 30 FTEs. So with our example, this 100 FTE company, you subtract the first 30 of those, which gives you a number of 70. You then multiply the 70 FTEs by 2970, and you're looking for this example company a penalty of $207,900. So obviously a steep penalty and not anything anyone will want to pay, regardless of your revenues. One thing to note, ACA penalties are prorated. So if you have an employee where you are compliant for ACA for part of the year, but other months you were not, and you'll see on the 1095 that we'll look at in a few moments, there is a monthly kind of reconciliation of your ACA. So, oops. All right, on that, 1 second. That's me. So it is prorated at $247.50 monthly. As I said, the penalty is going down slightly next year for your 2026 filings and 2025 compliance from $2,970 per month. It's going down $70 per FTE a month to $2,900 in 2025. The next penalty is the affordability, and not to say anyone wants to pay this either, but as you'll see here, the penalties are a lot less for the affordability piece. So the way that you would be struck with this penalty is if the coverage that you are offering to the employee did not meet that 8.39% affordability threshold. So the way that this would be triggered would be if the employee declined that coverage that you offered them and went to healthcare.gov or their state exchange and applied for insurance, and based on their income, qualified for a subsidy on that coverage that they sign up for through the exchange. And again, because of the current funding and the current program and the way they have the marketplace situated, you have to be a pretty high income earner to not qualify for a subsidy if you're not receiving an affordable offer from your employer. So again, in our example of a 100 FTE company, they did offer coverage, but for 4 of those full-time employees, the offer was not considered affordable. And these individuals went to the exchange and received a subsidy. The penalty on this is $4,460 per employee who receives subsidized coverage for unaffordable offer. So in this case, the penalty for those 4 individuals would be $17,840. This penalty is also being reduced for next year from $4,460 to $4,350 in 2025. So in addition to those two, there are also penalties for not complying with the paperwork aspect of the ACA. If you are late in filing your ACA forms with the IRS, they can impose a penalty of up to $310 per form. The cap on that is $3 million. That's up last year from $290. And then if they feel that if you didn't file at all, and they felt that it was intentional that you didn't file, the failure to file penalty is $630 per form, and there's no cap on that. And that's also up $50 from last year per form. Okay, so as I said, we're seeing quite a flurry of penalty letters. Sometimes they're more of an inquiry like, hey, based on some of your other tax filings, we feel you may have been an applicable large employer in 2021, 2022, whatever it might be. And then they kind of ask you to prove out that you were or weren't. And if you were, why didn't you file your ACA? So if you get one of those, A, don't panic. A lot of times in working with businesses directly, we found that the IRS was looking at something and maybe you had a lot of part-time employees or whatever it is, but the numbers don't add up and you were not subject, and we can write something up to let them know that you weren't subject and supply the payroll documentation to prove that you weren't subject and make that go away. Even if it does turn out that you're subject, don't panic about that either. We can always go back and get things filed and write up an explanation and hopefully get some forgiveness or some relief on the potential penalties. I will also say though, don't procrastinate. Um, Sometimes the turnaround time and the due date for a response can be fairly limited. They may only give you a couple weeks to respond, and especially if you're going to be looking to manufacture some filings that didn't take place when they should have, you need a little bit of time to get that done. It's not necessarily an easy task, so don't sit on those notices. Get in touch with the right people as soon as possible. So speaking of that, you want to make sure you reach out to whomever your payroll provider was for that time period. So again, the IRS hasn't been quick on these. We're seeing a lot of stuff for 2021 right now. So you may not have been with your current payroll provider at that time, but you do want to get as much information as you can from who you were with in that year. Um, Aside from the actual payroll data, you're going to want to access your records. Hopefully, if you were offering coverage, you were collecting waivers on any employees who were waiving their coverage, whether those be paper waivers or electronic waivers. It's going to be important that if an employee got a subsidy claiming that they did not receive an offer of coverage or an affordable offer of coverage from you as their employer, that you have proof that you did make that offer and that they waived it. So you're also going to want your open enrollment data, wage data, et cetera. And then either yourself or whomever you're working with from a consultative standpoint or legal counsel, depending on what the situation is, make sure you get that response into them prior to the deadline. One nice thing is we are seeing a lot of options where you're able to fax forms and fax responses rather than relying on the mail, which gives you a little bit more peace of mind about it getting where it needs to get to quickly. And then you kind of wait. So they've been pretty good about taking a look at whatever you send over, making a determination or maybe asking for additional information. And so just keep your eyes peeled for a follow-up response. Fortunately for us and our clients, we've gotten a lot of nice letters saying that thank you very much. You've satisfied our inquiry or our requirements and you're good to go. No penalty assessed. So that's the best case scenario, and that's what we shoot for each and every time. All right, so let's get into the weeds a little bit here and talk about information reporting requirements. So again, as I said, you're going to want to know whether you're a fully funded plan or self-insured plan. Those will slightly alter what you need to file for your ACA compliance. Um, if you're self-insured, again, you're going to be using the B forms rather than the C forms. You also might need to include more information about coverage of dependents, spouses, children, what have you, on those forms if you're self-insured. So what is all this paperwork all about anyway? And you're going to see a lot of weird codes and things that don't make sense. These forms are not in English. I'll give you that heads up if you've never seen one before. There's going to be one A's and one E's and two B's and two C's. It's not in English. But what these forms do, once you decode what all these numbers and letters mean, um, helps determine from the government perspective whether an employee was eligible for subsidized coverage on the exchange, um, and then whether you as the employer met your responsibilities under the Affordable Care Act. So a few more definitions. One is minimum essential coverage, and second is minimum value. So in order for you to meet your requirements under the Affordable Care Act, the plan that you're offering employees has to both meet minimum essential coverage and minimum value. If you're working with a health insurance broker, it's somewhat rare these days to find a health plan that doesn't meet minimum essential coverage and minimum value, but it may not be a bad question to ask your broker just to make sure that what the plans you're offering are ACA compliant. In terms of the affordability, and you probably heard me say 8.39% of household income, and you may have said to yourself, well, how do I know what their household income is? They may have a second job or a side hustle or have a spouse who works. Um, Very true. There's no way for you to 100% know what someone's household income is. So what the government did on that is create 3 safe harbors that we'll talk about in a second. So the 3 safe harbors for affordability. The first is what's known as the W-2 safe harbor. So um, this uses the box 1 of an employee's W-2 to determine what their pay is and how you can measure that against the affordability of your health plan. It's the gross wages in box 1. The second is a rate of pay safe harbor. So what you do there is take their hourly rate and multiply it by 130. So 130 is the monthly equivalent of 30 hours per week. So if you take their rate of pay, multiply it by 130, that's going to give you a number that you can measure your affordability of your health plan against. The third option, as time goes on, as the cost of health care goes up and up and up, becomes less viable for employers, is what's known as the FPL, of the federal poverty level safe harbor. So that is a number determined by the government each year, where if the employee's cost of the lowest option health plan falls below that FPL measurement, then you can use that as an affordability safe harbor as well. For this year, that's $113.20. So unless the cost for your employees is less than $113.20, you cannot use the federal poverty line safe harbor. One important note here is that you do not, to meet your requirements under the affordability aspect of the ACA, you do not need to fit everyone under the same safe harbor. You can mix and match it. So you can have some employees who meet it under W-2, you can have others who meet it under rate of pay, and others who meet it under FPL. Your system will be able to determine which safe harbor, if any, is met, and use that. So you do not have to use one or the other. You can mix and match to be compliant. Okay, so this is what the 1095 form looks like. And these are the ones that go to your individual full-time employees. They'll each receive a unique one of these that speaks to them regarding their information and their offer of coverage. So what you'll see here, unless you have an ICHRA plan, which we're going to talk about in a minute, you do not have to worry about the employee's age, but you do need to have the plan start month. So if you have something other than a January 1st benefit plan year, you're going to want that to be reflected here in the plan start month box that you see on the screen. The zip code doesn't have to be filled if you have a traditional health plan. That is also only if you have an ICHRA plan. You do need to put a zip code in line 17 if you have an ICHRA. So line 14, what that is going to tell the government and your full-time employee is what kind of offer was made to the employee. So we'll go over the codes in a second, but it's essentially there was an offer made to the employee. There was an offer made to the employee that could include them and dependents. There was an offer to the employee that could have included themselves and their spouse or the entire family. There is also a code if you did not make an offer to an employee. Sometimes you will see that and still be in compliance, and that all has to do with line 16, which we'll talk about in a second. But line 14 is going to say whether or not you made an offer to your employee and what kind of offer it was. Line 15 is going to be a dollar figure. That's going to tell you, again, not based on what the employee signed up for, but based on your least expensive employee-only option, what their out-of-pocket cost would have been if they had signed up for that, whether they participated in a plan with you or not. And then line 16 is going to be another letter and number code, and that's going to say what the employee did with the offer. So if they signed up for coverage through you and through the company, what you should see there is a 2C. Some other codes you may see would be one for the affordability safe harbor. So if they didn't sign up for it for your plan, for instance, but it was still affordable if they had, then you'll see which of those 3 safe harbors we just reviewed, the corresponding code for those. As I previously mentioned, you may see something that says you didn't offer coverage in a given month to an employee in line 14, but not a problem if your line 16 reflects that either they were not yet employed by you at that month or had left the company and were no longer employed by you that month, or if they were in their waiting period for coverage. So there are codes for all of those things that you may see in line 16 that make it okay. Also, relevant to that, COBRA coverage does not get factored into this at all. You are not on the hook for an employee once they leave your employment and are eligible for COBRA. You do not have to factor in the offer of COBRA or whether they took COBRA or didn't, or the cost of the COBRA. That doesn't play any role. Once they are terminated by you, whether voluntarily or involuntarily, your obligations for ACA compliance end as of that date. So these are some of the codes, just a cheat sheet. You don't need to memorize these. We make these available to all of our clients as they review the forms that we prepare to make sure that they're accurate. But as you see, there's a whole mess of codes. So these are the line 14 ones saying what kind of offer was made. As you'll note, different ones for fully insured plans and self-insured plans. Also, as you'll see highlighted in blue here, there are specific codes to use if you are offering an ICHRA or an ICHRA plan. Those have their own line 14 codes that you're going to want to use. And then in terms of the line 16, the line 14 codes start with a 1, the line 16 codes start with a 2. But for instance, the 2A says that they were not employed on any day during that given month, or 2B, they weren't full-time. As I said before, a 2C insinuates that they were on your group health plan for that month. But as you can see, there are all different kinds of options for 2. These are the most common for folks who did not. If you see a blank on line 16 that is potentially of concern, that may indicate that their offer of coverage was not deemed affordable. They did not fit into one of these safe harbors, and that coverage was not affordable. So that is something to look out for. If you see line 16 blank, that doesn't necessarily certainly, but may indicate that your offer was not affordable to that individual. Part 3 is really has to do with usually self-insured plans and dependents that were covered under that same plan or offered under that same plan. 1094, so your employees are not going to receive a 1094. The 1094 is strictly filed with the IRS. And this is kind of a summary of the business and of how you were in compliance with the ACA in the previous calendar year. So part 1 is just basic company information, name, federal ID number, address, so on and so forth. Line 18 is where you say how many 1095-Cs were created and issued to employees. You also need to file those 1095s with the IRS. There are certain rules if you are a controlled ownership group. So it is important that if you're considered a control group, so you may have separate federal ID numbers, but have common ownership. If that common ownership is enough to make you considered a control group, you do need to aggregate your employee counts and you may be ACA subject. So what I mean by that is, let's say one person owns 2 restaurants and both of those restaurants have 30 FTEs. Even though they have separate federal ID numbers, if the ownership is the same, that both of those restaurants are applicable large employers and their FTE count is 60. Part 3 of the 1094 is kind of where you declare for each month whether or not you offered minimum essential coverage to your eligible employees. You then have to list the number of full-time employees you had each month, as well as your total employee count, including part-timers in column C. All right, so as I said at the top, Affordable Care Act success really hinges on maintaining accurate employee records. So, any system, no matter how robust, is going to have to make some assumptions that if your employees are full-time and you have a benefit plan in place, that you most likely offered them coverage. It is important to review the forms for accuracy. So hopefully you're set up for success. I know we've got people who use a couple of different payroll and HCM systems here. There are different reports that can help you maintain compliance with those things. And we'll be having information about each of those respectively coming up soon in the next few weeks. So again, in talking with folks and working with businesses, a lot of companies are thinking about or have adopted ICHRAs. So for those of you who are unfamiliar and wondering what I've been talking about this whole time when I mentioned ICRAs, so these are relatively new. They've been around for going on 5 years this January. So uh, if you come from a smaller business, you may be familiar with QSERAs. So those work very similarly, but we're only available to small businesses. What an ICRA does is kind of create that same type of program, but opens it up to employers of any size. So what an ICRA is essentially a program where an employer doesn't have to offer a traditional group health plan, but instead can give employees a pre-tax, quote unquote, allowance that those employees can then use to go to an exchange and get insurance on their own. So essentially, you're giving your employees pre-tax dollars for them to go and find the coverage that works best for them. So if you have a multi-generational workforce or people with different needs and in different stages of life, and you're somewhat restricted on how many different plans you can offer and the cost of those, this creates a unique scenario where it gives employees some choice to be able to find the best fit for them in terms of their health coverage. So people who have a lot of healthcare needs can find a robust plan, maybe a gold or platinum level plan that has a lower deductible and has more robust coverage and lower copays, whereas you might have someone who uses healthcare very little and just kind of wants to have more of a catastrophic type plan with a very high deductible and higher copays, but will cost them less out of pocket each month. So this allows employees to pick what's best for them. So ICRAs were very carefully constructed to make sure that they meet the ACA requirements. So even if you don't offer a group health plan, if you're an applicable large employer, but you have an ICRA in place, as long as it's designed correctly, that will generally meet your ACA compliance requirements. Now, where the tricky part is, if you remember what we've been talking about here and meeting your affordability guidelines is you're always looking to meet the employee's affordability against the lowest cost option of a plan that you offer. Well, if you're not offering a traditional health plan, how do you measure affordability? Well, this is where the tricky part comes in here. So under the definitions of the ACA and the ICRA compliance piece, to determine affordability, what you need to do is find for that employee, either based on their home zip code or their work location zip code, um, the silver plan. So on the healthcare exchange, if you've ever been to it or if you haven't, they categorize plans based on bronze, silver, gold, and platinum. And those really describe how robust the coverage is for that insurance plan. So for affordability under an ICRA, you need to determine for that individual employee what the lowest cost silver level plan on the exchange would have been. And after your allowance, what their out-of-pocket cost would have been. And that's how you measure affordability. So what makes this tricky is, unlike a traditional group health plan where you use that same dollar amount for every employee, it's say, hey, everyone has a bit the availability to sign up for this plan that costs $200 a month. We're going to base our affordability against that. You can have a different affordability measure for every employee at your organization. So some of the factors that can alter that rate of that silver level pin would be the city, state, or zip code where they live, even within a state, even if you're all in one state. I work with a restaurant group who has locations all over a single state. And if those people work in the southern part of the state, the healthcare is more expensive versus the northern or western part of the state, it's less expensive. So the zip code can play a factor in that. Also, healthcare plans on the exchange can vary based on the employee's age as well as their gender. So being compliant with the ACA if you have an ICRA can be very, very tricky. You're going to want to make sure you give yourself plenty of time to get those forms furnished, completed, and filed because it's going to be more work than a traditional health plan. So you definitely have some advantages with an ICRA. You definitely get to punt on a lot of things that employers with a traditional health plan have to face, but I'd say you probably more than make up for it when you try to do your ACA filing at the end of the year. So some tips if you do have an ICRA or you're considering one and are a little nervous about ACA, first, I would definitely reach out to your ICRA provider or the person who's pitching ICRAs to you to ask about specifically how they help with ACA and what information they're going to be able to provide you to help you with your compliance. Also, definitely work with your payroll provider to explore options for how we can get these forms completed because, as you can imagine, if you have a traditional plan, we're going to have all those rates loaded in the system. We'll be able to populate those lines on the 1095 forms, but it'd really be impossible for us for any system to really know what the lowest cost silver level plan is for each employee. So there's going to be some work on that end. So work with your payroll provider to determine the best path forward there. As I said, make sure you're allowing yourself extra time to make sure that the forms are accurate and completed. And definitely utilize that work location safe harbor if applicable for you. So if all of your employees are reporting to one office, then you can at least use that zip code for all of your measures. And if you have people of the same gender and age, their numbers should be consistent. Whereas the other option is using their home zip code. And if you have people from traveling from near and far to your office, that can make things more difficult. So if you do have a singular or limited number of work locations, you may want to look into utilizing that safe harbor for your affordability measure. All right, so it looks like we have a few minutes for questions. Let me take a look at those. How would interim employees apply? So I'm not sure if this means interns or temporary employees. There are certain safe harbors for seasonal employees and short-term employees. We can send some information to attendees about that. There are specific rules. You need to make sure you're mindful of with that. Next question, is 30 hours the figure we need to use in calculating FTEs? Is 40 hours no longer acceptable? Yes, yeah, you definitely want to be using 30 hours both for your FTE calculation as well as determining which employees are eligible for your health plan. So if you say have someone who's working 35 hours per week, they should be eligible for your health plan under the ACA rules. And if you're not offering um, coverage to folks who are working more than 30 hours and less than 40, then that could potentially be an exposure for your business. So definitely start using 30 as your measure for full-time equivalents for ACA compliance as well as benefits eligibility. If an employee qualifies based on the look-back period, but their hours have fallen below full-time hours for employer contributions, is it compliant to charge the employee full price for benefits since they are not full-time during the eligibility period? You're going to be want to be really careful with that. If it's enough of a swing where they come off of the plan and qualify and move to the exchange, they may have a valid argument that they didn't receive an affordable offer from you. You really should maintain the offer as it stood when you were offered them the coverage during the entire stability period. So unless there's a formal change in their employment, so going from a full-time employee and they choose to become a part-time employee, maybe they go back to school or something like that. If there's a category change or a true status change to their employment, you may have some wiggle room, but if it's close and they fall below, you're probably going to want to keep them with the offer they received throughout that stability period. Great question there. Aren't 1095s optional for employees to receive? It isn't a requirement for employees to provide this documentation when filing their taxes, correct? If the employee wants a copy for their records, a 1095 should be issued. So technically under the ACA, I totally hear what you're saying in terms of when I personally complete my individual income tax return, I do not have to supply information found on the 1095. That is correct. But the federal government does still say that those need to be provided. So the most important thing is getting them to the IRS, obviously, because that's what they're tracking. But by the letter of the law, you are supposed to be furnishing these to your employees. Definitely, if you have employees in California, they're the strictest about it. So make sure you're getting them to them and getting them to them by January 31st. But technically, 1095s are required. All right. So this one is prefaced by, this is probably a stupid question. No such thing. We just found out that we have gone over the threshold of 50 FTE, so I don't really know anything yet. My question is, if we need to send out 1095Cs in 2025, or would it be 2026 for us since we are just starting to follow ACA rules as of 1/1/25? Great question. So as I said, a lot of companies are in great shape or have at least grown to the point where they are now ALEs. So how this works is you're always looking at the previous calendar year. So the folks who are going to have filings due in January to March of 2025 that are going to have to send stuff out in the next few months are businesses who were over 50 FTEs in 2023. So what that means is if you were over 50 FTEs in 2023, you needed to be compliant in the year that we're in now, 2024, and then need to reconcile and send out those 1095s in early 2025. If you just hit it this year, then you need to be compliant next year and send out your paperwork in early 2026. So really good question there. Do we need new waivers each year? Yes. I would definitely highly recommend new waivers each year because each year the employees, as we are in right now, have that open enrollment period through the healthcare exchange where they can sign up for coverage and qualify for subsidies each and every year. So you want to show that each year you did offer coverage and it was waived, because each year, if you are an ALE, you're going to have to file and say whether or not an offer of coverage was made. So you want that proof that the employee did waive the coverage. There's a question here about some of the coding. I mean, that one might be better for offline, but generally, if there was a day that they were subject, you want to treat that month as a valid month if they were covered for any days in that month. Yes, there will be a recording of the webinar sent out probably later today, hopefully, unless we had some technical difficulties. At what employee count are we required to offer health insurance? And is the cost of providing this benefit tax deductible for employers? So definitely want to talk to your accountant or tax professional in terms of tax advantages for offering a group health plan. But the magic number for being required, at least federally, is that 50 FTE count. So you want to look at your full-time equivalent count, and that's going to determine whether or not you have to offer coverage to your full-time employees. Good one here. We are not a large employer and are not subject to ACA. However, we do offer health benefits. What are your reporting requirements, if any? Um, unless yourself is, if assuming it's a fully funded plan, you're not individually going to need to file anything with the IRS related to this. If your plan is self-insured, then you may have requirements under your 1095 and 1094B forms. So if you're not sure whether or not you're fully funded or self-insured, reach out to the carrier or the broker you worked with to put your plan together and make sure that someone is filing those, either yourself or sometimes the carriers will be able to file those for you depending on the structure and how much of it is self-funded, so on and so forth. So check with your broker or your carrier if you're unsure whether or not you're self-funded, and if you are, what your responsibilities are. If we know an employee is part-time, would we classify them as variable because they are less than 30 hours, or would we mark them non-variable because they have a set weekly schedule? Great question. So if you know that they're being hired on a part-time basis, you do not need to offer them coverage and you do not need to mark them as variable. One of the things, the advantages to a variable hour employee is, rather than that kind of 90-day waiting period maximum that you have with your standard hires, you have up to 12 months to measure their hours and determine whether or not you're going to offer a variable hour employee coverage. But if you know with a fair amount of certainty that they're going to be working a part-time schedule, they do not have to be benefits eligible. You just want to make sure you check them every annual measurement period that you have to make sure that there wasn't some weird circumstance where they averaged full-time working hours. All right. And then one more question here. If an employee worked for the first half of the year but no longer works for the company, does the company need to prepare this and still send it to them? Yeah, so you're still going to want to send them a 1095C to illustrate the months that they were employed by you and that they were offered coverage, because you could still potentially be on the hook. Let's say you just didn't offer that employee coverage while they were a full-time employee of yours and they were eligible. If they go to the healthcare exchange, sign up for coverage, get a subsidy, that's going to trigger potentially a non-offer penalty for you that's based on your entire workforce. So do make sure, even if people are not currently employed by you, if they were a full-time employee for any month in that previous year, that you do get a 1095C out to them. All right, and then I promise this is the last one because I know we're running up on time. This is a good one though, so I want to make sure I get to it. If an employee is riding the line between full-time and part-time and sometimes drops below 30 hours, but sometimes works just over 30 hours in a week, could you briefly talk through what that would look like when considering ACA? How often should that be monitored? And if an employee happens to average below 30 hours a week for the measurement period, at what point is their average monitored again to know if they need to be offered benefits? Outstanding question. So this is really where you want to strategize, depending on your work demographics and your type of business, what the appropriate measurement period is for you. So it's all going to hinge on what you use for a measurement period. If you're using a 12-month measurement period and someone fails to meet that 30-hour threshold, you do not have to offer them that coverage. And similarly, your stability period for not offering them that coverage extends for that entire following 12 months. So what I mean by that is if someone, let's say you do a 12-month measurement period and employee A averages 31 hours per week and employee B averages 29 hours per week, you have to offer employee A health insurance and you have to keep that offer valid for the 12-month stability period for the entire following year. For employee B who fell below, you do not have to offer them coverage and you do not have to recheck that until your next measurement period 12 months later. If you decide to use a different length measurement period, same rules apply. If it's 6 months, then you're good for 6 months and checking it that often, but you don't need to be checking this on a pay period by pay period basis. There is something that I didn't cover in this because it isn't as popular and can be really administratively burdensome, but the other option as opposed to the look back period is what's called the monthly measurement period. In that circumstance, you're looking at your entire workforce every month and offering, declining, or removing coverage and making COBRA offers to everybody on a monthly basis. The sensibility of that is really limited in scope. So we generally don't recommend it unless you're in a really unique circumstance. If you're using the monthly measurement period, then that's a once a month look back. Otherwise, it really depends on what your measurement period is, and in most cases, 12 months. All right, so that brings us to the end of the questions that we can answer in our hour here. Thank you so much for joining us today, and I'll hand things back over to Katie to close us out.
Thank you so much, Paul. We really appreciate your time. It's always great every time Paul's a speaker on our webinars, but we will be sending out the recording and this presentation as promised. We'll also be sending out a link to a quick 2-minute scorecard that provides you a grade and will assess like if you may be at risk for ACA fines or penalties. So that will be coming out in the follow-up email as well. To learn more about NPHR services, visit the link that I dropped into our chat. And then be sure to join us for an upcoming webinar next month for the 2024 HR year in review and a glance into 2025. To register and see the full calendar of upcoming events and available resources, you can visit us at mp-hr.com. Again, thank you everyone for visiting and watching and joining our webinar today. Have a great rest of your day.